One of you retired. One of you is still working. The one who retired did everything by the book, filed for Social Security at the right age, set up direct deposit, adjusted the household budget around the monthly benefit, felt the quiet satisfaction of a system finally paying back after 40 years of contributions. The one still working is doing it for any number of reasons. Maybe they love what they do and are not ready to stop. Maybe the household needs the income for a few more years. Maybe they are waiting to maximize their own Social Security benefit by delaying until 70. Whatever the reason, they are still earning a paycheck, and the household is running on two income streams, one from work and one from retirement. And you both believe those two streams are separate. The paycheck belongs to the working spouse. The Social Security belongs to the retired spouse. The IRS has no business connecting them. The IRS disagrees, and the IRS has documentation. IRS Topic 423, the official government page on Social Security income tax, contains one sentence that most American couples have never read and that most financial advisors have never explained to their clients who are living exactly this situation right now in 2026. The sentence is this: on a joint return, you must add your spouse's income to yours when figuring if any of your benefits are taxable, even if your spouse did not receive any benefits. Read that one more time. Even if your spouse did not receive any benefits. The working spouse has not filed for Social Security yet. The working spouse is not receiving any benefits. And their entire earned income is still being added to the retired spouse's income in the formula that determines how much of the retired spouse's Social Security check gets taxed. The paycheck is contaminating the retirement check through a formula written in 1983 in a government publication most Americans have never opened, collecting federal income, tax on retirement benefits that would be completely tax-free if the retired spouse were filing a loan on their own income. This is the working spouse Social Security contamination trap. And I want to be clear about something. Before we go one sentence further into the mechanics of this thing, this trap works in both directions. If the husband retired, and the wife is still working, her paycheck is contaminating his Social Security. If the wife retired and the husband is still working, his paycheck is contaminating her Social Security. If both spouses are at different stages of retirement, with one collecting and one earning, the formula combines both incomes regardless of which name is on the paycheck and which name is on the Social Security award letter. The IRS does not care about the direction. It cares about the joint return. And on a joint return, everything is combined. I am the digital defender. I have spent weeks going through IRS Topic 423 and IRS Publication 554 line by line. And what I found in the married filing jointly section of the Social Security taxation rules is a mechanism so perfectly invisible in day-to-day household financial life that millions of American couples are paying federal income tax on retirement benefits every April without understanding why the number keeps being larger than they expected. Their financial advisor runs the return correctly. Their CPA calculates the taxable benefit amount accurately, but neither of them is sitting down with the couple and saying the working spouse's income is the specific reason the retired spouse's Social Security is being taxed. And here are 5 things you can do about it right now. Smash the like button right now, not at the end, right now, because the algorithm in 2026 suppresses independent senior financial content, and every like on this video pushes it into the feed of one more couple where one spouse retired and the other kept working, and neither of them knows the IRS is combining their incomes in a formula that is costing the retired spouse thousands of dollars per year in avoidable federal income tax. One tap. Do it. Subscribe and flip the notification bell, because this is the archive and I release a new investigation exactly like this one every single week. This is not financial advice. This is the masterclass on a tax formula that has been running against American married households for 43 years, while both spouses assumed it did not apply to them. Let me walk you through the exact mechanics, because once you see the formula, the contamination becomes impossible to ignore. IRS Topic 423 defines combined income as the number the IRS uses to determine Social Security taxation. The formula works like this. Take your modified adjusted gross income, add any tax-exempt interest you received during the year, including municipal bond interest, then add 1/2 of your Social Security benefits. The total is your combined income. And combined income is the number the IRS compares against the base amount for your filing status to determine how much of your Social Security check is taxable. For married couples filing jointly, the base amounts are these. If combined income is below $32,000, none of the retired spouse's Social Security is taxable. If combined income is between $32,000 and $44,000, up to 50% of Social Security may be taxable. If combined income exceeds $44,000, up to 85% of Social Security is taxable. These thresholds, $32,000 and $44,000, have not been adjusted for inflation since they were written into the tax code in 1983 and expanded in 1993, not once in 43 years. In 1983, $44,000 represented a genuinely high combined income for a retired household. In 2026 dollars, it represents a modest fixed income that millions of retired American households exceed without even counting the working spouse's income. Now add the working spouse's income to the formula. The modified adjusted gross income that feeds into the combined income calculation includes all household income on a joint return, wages, pension income, IRA distributions, dividend income, rental income, and the working spouse's entire earned income. Every dollar the working spouse earns at their job goes into the METJAG calculation before the formula even runs. The retired spouse's own income may sit comfortably below the threshold in isolation. The moment the working spouse's earnings are added, the combined income explodes past the $44,000 ceiling, and 85% of the retired spouse's Social Security becomes taxable. Let me show you this in real numbers with a couple named Robert and Linda, so the financial consequence is personal and specific. Robert is 68 years old. He has been working as a project manager for a manufacturing company for 31 years. He is good at what he does, and he is not ready to retire. His annual salary is $58,000. Linda is 65 years old. She retired last year when she turned 65, and Medicare became available. She spent 28 years as a school administrator. She collects $2,200 per month in Social Security benefits, $26,400 per year. She has a small pension of $9,600 per year. She has a taxable brokerage account that generates $2,400 per year in dividends. Linda's own income, before adding Robert's earnings, pension $9,600 plus dividends, $2,400 equals $12,000. Run Linda's combined income as a single filer on her own income only. Imagine you have $12,000 plus one half of Social Security. $13,200 equals combined income of $25,200. The single filer threshold, where Social Security begins becoming taxable, is $25,000. Linda is barely above the threshold as a single filer, and a tiny portion of her Social Security, less than $110, would be taxable on her own income alone. Now file jointly with Robert. Household Magi, Linda's $12,000 plus Robert's $58,000 equals $70,000. Add one half of Linda's Social Security, $13,200. Combined income, $83,200. $83,200 is nearly double the $44,000 threshold, where 85% of Social Security becomes taxable. Linda's entire $26,400 Social Security benefit is 85% taxable. That is $22,440 of her Social Security treated as ordinary income on the joint return. At a 22% federal marginal rate, that is $4,937 in federal income tax on Linda's Social Security benefits this year. Robert's paycheck transformed Linda's nearly tax-free Social Security into a $4,937 annual tax bill. Not because of anything Linda earned, not because of any financial decision Linda made, because the IRS combines all household income on a joint return, and Robert's salary pushed the combined income formula to its maximum inclusion level. Over 10 years of Robert continuing to work, that is $49,370 in federal income tax on Linda's Social Security, before state income tax in states that tax Social Security benefits. Before any IRMA exposure, if the household income crosses Medicare premium surcharge thresholds, before any compounding effects from increased income pushing other deductions and credits out of reach. Now flip the scenario completely, because this trap is not gender specific and it is not role specific. Linda is 68 years old. She has been a registered nurse for 33 years, and she is not done. She works 4 days a week at a hospital system she loves. Her annual income is $62,000. Robert is 70 years old. He retired 3 years ago when he turned 67. He spent his career in manufacturing management. He collects $2,500 per month in Social Security, $30,000 per year. He has a pension of $8,400 per year. His brokerage account generates $3,000 per year in dividends. Robert's own income before adding Linda's earnings. Pension $8,400 plus dividends $3,000 equals $11,400. As a single filer, Robert's combined income would be $11,400 plus one half of Social Security. $15,000 equals $26,400, above the $25,000 single filer threshold, but only barely. The modest portion of his benefits would be taxable on his own income. Now file jointly with Linda. Household Mag, Robert's $11,400 plus Linda's $62,000 equals $73,400. Add one half of Robert's Social Security, $15,000. Combined income, $88,400. Robert's entire $30,000 Social Security benefit is 85% taxable. That is $25,500 of his Social Security treated as ordinary income. At 22%, that is $5,610 in federal income tax on Robert's Social Security this year, driven entirely by Linda's nursing income. Same trap, opposite direction, identical mathematical outcome. Linda's paycheck contaminating Robert's retirement check through the same IRS formula that contaminated Linda's check in the first scenario. The formula does not care which spouse is working and which is retired. It pools the income, it runs the calculation, it taxes the Social Security, and it does this every year without sending either spouse a letter explaining that the working spouse's continued employment is the specific mechanism driving the retired spouse's Social Security tax bill. Stop for 30 seconds. Think about your household right now. Is one of you retired and collecting Social Security while the other is still earning a paycheck? Has your tax preparer ever shown you the Social Security worksheet and specifically pointed to the working spouse's income as the line item driving the taxable benefit calculation? Has your financial advisor ever brought up the combined income formula in the context of coordinating retirement timing between both spouses? If the answer to the first question is yes, and the answer to the other two is no, you have been paying the working spouse contamination tax for every year. This arrangement has been in place, and you will keep paying it until someone gives you the strategies I am about to deliver. Send this video right now to one couple you know where one spouse retired and the other kept working. A neighbor, a sibling, a coworker who mentioned their partner just started collecting Social Security. Not after you finish watching, right now while the thought is alive. Because every year this arrangement continues without these strategies in place is another $4,000 to $8, $500 in avoidable federal income tax paid on retirement benefits that the law protects, except when the combined income formula triggers at the $44,000 threshold that Congress froze in 1993 and has never touched since. Now let me explain who built this trap and why they never fixed it, because the history is important for understanding why the contamination keeps running silently in millions of households. Congress built this formula in two legislative acts separated by a decade. The first act was 1983. The Reagan administration and a bipartisan Congress were facing a Social Security solvency crisis. The Social Security trust funds were projected to be depleted within months. An emergency fix was needed. The Greenspan Commission recommended making a portion of Social Security benefits taxable for the first time in the program's history. Congress agreed. The original base amounts were set at $25,000 for single filers and $32,000 for married couples filing jointly. At those income levels, in 1983, the rule was designed to affect only upper-income retirees. It was sold to the American public as a tax on the wealthy. The second act was the Clinton administration needed revenue to fund the Medicare Trust Fund. A second tier of Social Security taxation was added. For combined income above $34,000 for single filers and $44,000 for married couples, up to 85% of Social Security benefits became taxable. Again, it was characterized as affecting only higher income retirees. In both 1983 and 1993, Congress chose not to index the thresholds for inflation, no annual adjustment. No mechanism to ensure the thresholds kept pace with rising incomes and rising Social Security benefit amounts. In 1983, the $32,000 joint threshold was approximately 139% of median American household income, a genuinely upper income standard at the time, In 2026, the $44,000 joint threshold is approximately 55% of median American household income. A threshold designed to catch only wealthy retirees in 1983 now catches the majority of retirees, American households, and catches them particularly hard when one spouse is still working because a single working age salary is often enough to push the combined income calculation well above $44,000 on its own. The congressional staff who scored these provisions in 1983 and 1993 knew exactly what static thresholds in a growing economy would produce over a multi-decade horizon. The revenue projection models show the trajectory clearly. They chose static thresholds anyway because static thresholds generate predictable and growing revenue without requiring Congress to ever vote explicitly for a tax increase on retirees. Inflation does the work. Congress takes no vote. The threshold catches more retirees every year automatically. Your Social Security is being taxed more every year, not because you're wealthier than the retirees of 1983, because the threshold that was supposed to protect you has not moved in 43 years, while everything else has. And the working spouse contamination is the most powerful element of that strategy because it reaches outside the retired person's own income and pulls the working spouse's earnings into the calculation. The retired spouse did not earn that income. The retired spouse cannot unilaterally reduce that income. And asking a spouse to retire early to reduce a tax bill is not a conversation most couples are equipped to have without understanding exactly what the tax bill is and exactly what alternatives exist short of early retirement. That is what the next section is for. Mid-roll AD break. 5 specific strategies that reduce or eliminate the working spouse contamination without requiring the working spouse to retire before they're ready. Defense strategy 1 is the traditional 401k and IRA contribution maximization approach. The working spouse's earned income enters the combined income formula as part of household MEGI. But contributions to a traditional 401k or traditional IRA reduce MEGI dollar for dollar before the combined income formula runs. A working spouse who maximizes traditional 401k contributions, including the catch-up contribution available to workers over 50, can reduce the contaminating income significantly. On a $58,000 salary, a working spouse who contributes the maximum traditional 401k amount reduces the household MEGI by that full contribution amount. The combined income drops. The percentage of the retired spouse's Social Security that is taxable drops with it. This is the single most powerful contamination reduction strategy available because it requires no retirement, no lifestyle change, and no sacrifice beyond direct delay. More of the working spouse's paycheck into a tax-deferred account where it continues compounding for their own eventual retirement. 2 goals achieved simultaneously: lower current year Social Security taxation and higher retirement savings for the working spouse. Defense strategy 2 is the health savings account strategy for working spouses with a qualifying high-deductible health plan. HSA contributions reduce modified adjusted gross income dollar for dollar, just like traditional 401k contributions. A working spouse who contributes the maximum family HSA amount in 2026, including the catch-up contribution available to those over 55, reduces the household MEGI that feeds into the combined income formula by that full contribution amount. The HSA funds grow tax-free, can be invested in diversified funds, and distribute completely tax-free for qualified medical expenses now and in retirement. Maximizing both the traditional 401k and the HSA simultaneously creates the largest possible MEGI reduction from the working spouse's compensation and can move the household combined income below the threshold tiers that determine Social Security taxation. Defense strategy 3 is the Social Security claiming coordination strategy between both spouses. If the retired spouse has not yet begun collecting Social Security, the decision of when to claim must be modeled against the working spouse's income explicitly. Delaying the retired spouse's Social Security while the working spouse is still earning means the combined income formula has no Social Security benefit to include. Once the retired spouse begins collecting, the Social Security amount appears in the combined income formula as a positive number that pushes the calculation higher. In some households, it may be advantageous to delay the retired spouse's Social Security until the working spouse retires and the household income drops to a level where the benefits will be only partially taxable or tax-free entirely. This strategy needs to be modeled carefully because delayed claiming creates a higher monthly benefit that may be worth a temporary foregone income depending on the household's specific numbers, life expectancy assumptions. Defense strategy 4 is the Roth conversion and contribution strategy for the working spouse's retirement savings. Roth 401k contributions and Roth IRA contributions do not reduce current year MAGI the way traditional contributions do. This means they do not help with the current year contamination problem. But Roth distributions in retirement are completely excluded from modified adjusted gross income and therefore invisible to the combined income formula permanently. A working spouse who builds a substantial Roth balance during the remaining working years creates a retirement income source that will never contaminate either spouse's Social Security taxation in the future. After both spouses are retired, the household can draw from the Roth account without triggering Social Security inclusion on either benefit. The immediate strategy for the current working years is traditional contributions to reduce current MAGI. The long-term strategy is building Roth assets that make the post-retirement household invisible to the contamination formula permanently. Defense strategy 5 is the income timing and deferral strategy for working spouses who have flexibility over when their compensation is received. Self-employed working spouses, business owners, contractors, and consultants can sometimes defer income from high earning years into lower earning years by controlling when invoices are sent, when contracts begin, or when variable compensation is taken. A working spouse whose income is pushing the household well above the $44,000 combined income threshold may benefit from deferring a portion of income into the year the working spouse plans to retire, when the annual income will be lower because it covers only part of the year. The year, final partial year of employment, often produces the lowest annual earned income of the working spouse's career and can be the optimal year to receive deferred compensation that would have caused severe contamination in a full earning year. Here's what connects everything we covered today. The IRS built a combined income formula for Social Security taxation that pools all household income on a joint return, regardless of which spouse earned it. A working spouse's paycheck and a retired spouse's Social Security benefit live in the same formula. The thresholds that determine how much of the benefit is taxable have not been adjusted for inflation in 43 years. And the contamination runs in both directions with equal force, whether the husband is working and the wife retired, or the wife is working and the husband retired. The trap is the combined income formula and the frozen thresholds. The deeper trap is the invisibility. The working spouse sees no mechanism connecting their paycheck to their partner's retirement benefits. The retired spouse sees no line on their Social Security statement explaining why the benefit is being taxed. The tax return shows the result, but rarely explains the cause in terms that make the working spouse's income the identifiable driver of the retired spouse's tax bill. The escape is specific and executable. Maximize traditional 401k and HSA contributions from the working spouse's income to reduce the contaminating MAGI. Coordinate Social Security claiming timing against the working spouse's retirement date. Build Roth assets that remove future distributions from the combined income formula permanently. And explore income deferral strategies for working spouses with compensation flexibility. The difference between knowing these strategies and not knowing them is $4,000 to $8,500 per year in unnecessary federal income tax on Social Security benefits. Over 10 years of the working spouse continuing to earn that is between $40,000 and $85,000. That money belongs in your household, not on a tax return generated by a formula Congress froze in 1993 and has never revisited. You now know the formula exists. You now know it runs in both directions, and you now know 5 specific ways to fight it without asking your partner to retire before they are ready. Before you leave, do 3 things. Smash the like button right now because it is the only mechanism that tells the algorithm to push this investigation into the feeds of the couples living the situation right now who have no idea the work spouse's income is driving the retired spouse's Social Security tax bill. One tap, do it now. Subscribe to this channel and flip the notification bell to all. I release a new investigation every single week. New formulas, new traps, new strategies buried in government publications the financial planning industry is not explaining to their clients. This is the archive. You want to be inside it. Drop a comment below right now. Tell me which direction your household runs. Is it the husband still working with the wife retired, or the wife still working with the husband retired? Tell me your state. Tell me whether your financial advisor or CPA has ever specifically identified the working spouse's income as the driver of the retired spouse's Social Security tax bill. I read every single comment. Your situation becomes the data point that tells the next couple landing on this channel that they are not alone in having missed something this important for this long. I will see you in the next investigation. Stay sharp, stay protected, and do not let the IRS collect a single dollar of tax on retirement benefits you spent 40 years earning through a formula they wrote in 1983 and have never had the courage to fix.